Welcome to the Fiscal Physical Podcast. Join us each week as we sit down with the founder of Alchemy Wealth Management and author of Your Fiscal Physical, Ryan Nelson. Tune in to gain valuable insights and practical tips as we simplify complex financial concepts into digestible lessons. From budgeting to retirement planning, this podcast is your go-to resource for mastering financial literacy.
Welcome, everybody, to this week's episode of the Fiscal Physical Podcast. I am Aaron Hoisington. I am joined by Ryan Nelson. We are here to hopefully increase your financial literacy with the Fiscal Physical Podcast. If you guys ever want to get in on this action, too, I definitely recommend emailing us at podcasts@alchemywealth.com with feedbacks, topics, anything you guys want to discuss. We love our listener questions, so please let us know if you guys have anything. We'd love to cover it for sure. But I guess I should start with this here. Ryan, how are you today? Are you feeling healthy?
I'm feeling pretty darn well. How about yourself?
I'm feeling good, man. I'm feeling good. It's a beautiful day here. We're recording. I'm learning. It's awesome. So I appreciate you taking the time out of your busy day. And let's dive in. Oh, this is going to be a fun one here because we are going to talk today about investment properties and taxes. And yeah, I guess. I hope so. We're going to see. But I'm sure that you kind of come across this as a financial advisor sometimes, Ryan, or maybe commonly about people who have retirement plans or financial goals, and they might have investment properties or be looking to get into the investment property. Like, there's so many different shows now on online or wherever you can find that are flipping houses or using them as rental properties, whatever that might be. So I think today we're going to talk about some, the advantages of that, maybe potential pitfalls, tax breaks. You covered it a little bit in your book too. So I'm curious to see what you kind of have to say on that subject.
Yeah, absolutely. Let's talk about it. So investment properties can be an awesome investment. They can also be a terrible investment, right?
And that's the end of the podcast.
Yeah. I don't know that just in general, again, I think there's good investment properties. There's bad investment properties. Oftentimes I hear people talk about them like they're absolutes. Some people hate them. Some people love them. And it's like, it's really just dependent. Some people have found these awesome opportunities that turn into amazing investment opportunities. And some people, try to force a round peg into a square hole and they buy something that just was never a great opportunity and end up losing a lot of money on, right?
Definitely.
In general, I hear one thing I will say is around just investment properties. I hear people say, I want investment property for the passive income. Have you heard that?
Yeah. Oh, definitely. Absolutely. That is a buzzword that goes right with investment property is passive income.
Which I find interesting. I don't know that there is a definition of passive income. To me, I imagine passive income meaning there's no work associated with it. I'll tell you, for investment properties, and anybody who has investment properties is listening to this knows that that's not the case. Yeah. There is work, right? You have to find somebody to live in the house. You have to somehow find somebody who's willing to pay you. You have to make sure they are paying you. If the refrigerator goes out, it's not your tenant's responsibility to replace that refrigerator. It's your responsibility, right?
Right.
If there's a fire, now you got to find your tenants somewhere else to live, right? Or not collect rent. If when the tenants move out and the carpet is in terrible condition, you probably just can't rent it to the next tenant like that. You got to replace it, right? So there's lots of work that come with being a landlord. That being said, you can delegate some of those. So you could hire a property manager and delegate some of those responsibilities and make it a little more passive for you, right? But there's expenses that come with that. I think most property managers charge around 10%. Okay. So that's a significant amount. So just be prepared that it's probably not as passive as you want it to be. And in order to make it more passive means it's more dollars out of your pocket, right? But so around investment properties. So, one of the benefits around investment properties can be the tax implications.
Right.
And I think that, you'll hear... First, I'll say I'm not a tax professional, right? You're going to want to talk to your CPA. One of the hard parts around this is tax law is always changing.
Right.
And so, quite literally next year, 6 months from now, we could see changes to this that would take place in the future, or your unique situation may be slightly different, right? We could never cover all the nuances of the tax code, and so a lot of the statements we'll make are very general statements that may apply to 80% of people. But if you're one of the 20% of people it doesn't apply to, you'd certainly want to do your due diligence before making any decision, right? But one of the benefits is some of the expenses associated with investment properties can be tax deductible. Right. And I think we'll talk in a future episode about what tax deductions sort of actually are or mean. But for purpose of this, what a tax deduction means is it's going to reduce how much you pay in taxes. So there's an investment potential option out there where the expenses associated with it could reduce how much you pay into taxes. So that sounds like a pretty good deal. And so there's like you pay your mortgage interest and property taxes. That could all theoretically potentially be deducted. You're going to have insurance for your house. So again, these are all expenses. So think of all of these things layering on as expensive. Right. The benefit is the expense gets deducted. That doesn't mean the expense doesn't exist. The expense is still there. So any of the revenue you're bringing in, you're going to have to subtract all these taxes out. Will it help lower your taxes? Yeah, a little bit. But you still have these expenses, right? If you're running your investment property like a business, which hopefully you are at that point, if you need to make improvements to the property itself, so some sort of upkeep or maintenance, oftentimes those can be deducted as well, right? Those are just a necessary expense for you to run this business effectively. And also, if you need a property manager, there could potentially be some tax savings there, as well as depreciation. So the important thing to know is there are deductions, but again, they're deductions on expenses. So if you had a $100 expense, it's nice to be able to deduct that expense. What's even better is not having the expense to begin with. Right? Like the expense, the deduction might save you like $20, right? Yeah. Like or rough order of magnitude. If you have an expense of $100 and you get to deduct it, you're like, oh, cool, that saves me $20. Well, you still paid $100, so you're still net minus $80 in this scenario, right? So I think there's a funny, what is it, Schitt's Creek? Yeah. I can't remember the kid's name, the boy, but he starts a business and then it's like turned into this funny meme where he's buying all this stuff and he's like, no, it's getting deducted. Don't worry about it. It's getting deducted. And then his dad's like, do you know how a deduction works? Right. And like, he clearly doesn't. He was thinking that because he was deducting it, it was free. It's free. And that's actually not that. The reason why it's funny is because a lot of people actually do sort of assume that's what a tax deduction means. Right. And that's not what a deduction means. So it's important when I hear people talking about the tax deductions associated with the investment property. Again, remember, what's better than a tax deduction is not having the expense to begin with. Exactly. If you're going to have the expense and the investment still pencils out, heck yeah, if you can deduct it, that's awesome, right? So I'll pause there for a second. What?
Yeah, no, I think you hit on a lot of good things as far as like in building into future episodes as well as with deductions. Maybe we'll talk about those and how they play out. But the one thing that was really interesting that I saw in your book was the depreciation aspect of like how like the IRS or whatever views like property tax or investment properties. So like I always thought that was interesting because normally like you think about a value of a house generally goes up. Like that's not all the time, but I would say that most of the time, if you keep something at the same rate, whatever, it's probably going to go up in value. At least here in Reno, we've seen that. But with these, they're different, though, right? Is that how they consider them like a depreciating asset? Is that what I was reading correctly?
So you can take depreciation. So if we think about a round example, so let's say you bought a house for $500,000. Okay. You just bought it cash. So you paid it completely off, $500,000. Normally, if you just kind of think about how taxes normally work, if you bought a house or let's say any investment, don't even worry if it's a house, just any investment, you go buy it for $500,000, it grows to say $750,000, and then you sell it. So you bought it for $500,000, you sold it for $750,000. That $250,000 of gains is what you would have to pay taxes on, right? There is an opportunity where you could now, if you're buying certain real estate, you could depreciate that. So and there's different ways to appreciate it. So you definitely want to talk to your CPA, discuss what makes the most sense for you if you're even eligible to do this. But so it would help you reduce your taxes this year. You'd be accelerating the depreciation potentially into current years. And then so it would reduce your tax burden this year, but what's happening is it's reducing your cost basis. So again, if you bought this house for, these aren't even realistic numbers, but let's just say you bought this house for $500,000, you paid for it all in cash. In the first year, you depreciate it by $100,000. That means your new cost basis would go from $500,000 to $400,000. So if you sell it after that year for $750,000, like we said,
Gotcha.
Now the gains, instead of looking at like it would be $250,000, your gains are actually $350,000 because your basis went down to $400,000. So you're kind of giving up your basis in exchange for a tax benefit. So you're not getting out of paying your taxes, right?
Yeah.
You're lowering your tax bracket or your tax burden this year, which lowers your basis, which means when you sell it eventually in the future, then you have to pay that back in taxes, right? And so, not that it's necessarily bad. It's just you have to understand that it's, for some people, depreciating the property could actually be worse for them long term when you look at how much taxes they'll pay over their lifetime. For some people, it's better for them, right? There's not just a universal answer, it's better for everybody or worse for everybody. So oftentimes or it's not often, but sometimes you'll see these scenarios where somebody will be depreciating a property, and it's like, well, that's probably actually going to be worse for you long term, right? And in theory, if you depreciate it all the way down to zero, you'd get all the way down to zero. Your basis in it would be zero. You go to sell the property for $750,000. You owe taxes on all $750,000, right?
You're going to pay the taxes,
right? And again, how real estate is taxed is potentially a little bit different and stuff. But for rental properties, it's largely sort of quote unquote normal. But you can imagine that may not be the best thing in the world.
Sure.
It looks good for your taxes this year, right? If you're looking at your uncle's tax return and he's showing you, man, I bought this property 2 years ago. Look, it's reducing my taxes here, and here. It's like, yeah, that looks pretty darn well. And then, it's only showing you this small snapshot, this sliver of the equation. You'd want to look at it over the entire life of the property, including when he sells it. And now how's he being taxed when he sells it?
Right.
That's something to think about.
Yeah, absolutely. And just one more, I don't know if it's going to be quick, but I think it will be. But with this, do you consider like rental properties, like do you lump them into the same category as like how you do with like your home, like for somebody? So if somebody comes in, they're like, oh, I have X amount of assets. Would you consider do you take that into consideration with like the rental properties for like planning for retirement and such too?
Yeah, I would think so. I think what you're alluding to is we've talked before on this podcast about potentially not including your home.
Right, exactly.
So of course, by definition of net worth, your home is included in your net worth. Any rental property is included in your net worth. Really, by definition of true net worth, everything is included in your net worth. Your laptops, your cars, your TVs, right?
Sure.
Now, for all practical purposes, like, is including your TV in your net worth meaningful? Probably not, because in all reality, by the time you get rid of it, it's like worthless, right? I think as we apply sort of like just conventional logic to some of this, it's like, okay, that doesn't really make sense, right? And so typically I would encourage people not to apply their home value. Think about it as net worth as far as retirement planning goes. It's not a liquid net worth, right? If you sell your house, you're going to have to buy a new house. You need a roof over your head.
Right, definitely.
And alternatively, though, I would consider rental properties part of somebody's like retirement assets. So it is potentially liquid. They could sell the rental property, go buy, retirement assets. They don't need the rental property for the roof over their head. So I would think of it as just another investment.
Okay, cool. Awesome.
The other thing I want to make a point on.
Definitely.
So again, let's say I had $500,000. Maybe I go buy a rental property with that $500,000, right? The rental income you generate from that is taxed at ordinary income rates. So if I generate $2,000 a month, so $24,000 a year, that $24,000 a year, I'm going to have some deductions that we kind of mentioned. But in theory, if I'm after all my deductions, I still have $24,000 of income. That's taxed at ordinary income rates. That's like your normal tax rate, the same tax rate you're being taxed on just from your income from your work. Whereas there's certain investments out there. If you go buy some maybe if you took that same $500,000 and you bought stock with it, and in the future, you own that stock for over a year and you start selling $2,000 a year for what you need, that would be taxed at long-term capital gains rates. Right. So the same $5,000 from a rental property, again, it could be that what is kicking off could be taxed at ordinary income rates, whereas some investments might be kicking off long-term capital gains rates. So you also want to just be considering what the actual tax rate of the income you're generating is. And in general, ordinary income rates are higher than long-term capital gains rates. Again, this could all change in the future. Who knows? But that'd be something else to consider.
Definitely. Absolutely. That's a great piece to think about. Like, hey, like what else? I like the way that you kind of think too. Like, hey, that could be a good idea, but what else could you do with potentially that money? The opportunity when what would make the most sense for what the person's goals are, what they want to accomplish. Is it just owning 8 properties? If that's like you're really passionate about that, awesome. Or maybe if you just want the $2,000 a month, is there a better way that we could potentially get that and you pay less taxes on it overall?
And I think I've seen people where their real estate portfolio, is averaging net, like after you look at all the expenses and everything, they're averaging like 2% returns or even less. Right. Where it's like, gosh, you probably would have been better off in the stock market. You're getting way underperforming the stock market and you have more responsibility, right?
Yeah, definitely. Yeah.
Whereas there's some other people who they just got some great opportunities, bought at the right time, or bought, so there's just that's life, right? Some opportunities are better than others, and you'll find some people it's like they're making 50% on their real estate. It's like, that was a fantastic opportunity. You wouldn't have wanted to pass that up, right? Yeah. And so again, it's just to reemphasize, like these investment properties are neither good nor bad. Some opportunities are good, some opportunities are bad, but you certainly would want to do your due diligence and actually understand the tax implications prior to. You would need to know the tax implications before being able to evaluate if the opportunity is good or if it is bad.
Yep. Awesome. I appreciate it, Ryan. That was a solid dive into that for sure. And we'll go ahead and pause, let everybody chew on that, and we'll be right back with the personal section. Everyone hang tight.
And now, to put the personal in personal finance.
Welcome back to this side of the Fiscal Physical podcast. I am still here with Ryan, and I have a burning question for him that I've been marinating on here. So, Ryan, I'm gonna go ahead and ask you this: what was your first job, and how did it, if at all, shape your perspective on money?
Yeah, I can't remember the exact timeline. I had 2 jobs basically in high school. I can't remember which came first. One, though, I worked at a pizza shop. So I don't know how old I was, like 15 or 16 years old or something. And so I worked there for one day. And I was playing soccer at the time, and the guy wanted me to like come in during my soccer practice. Was like, well, I can't, whatever. Right. Yeah. And he was just paying everybody cash under the table. It was a mess. So I don't know what takeaways I would have from that. I don't know. That's certainly paying your employees cash under the table isn't going to incentivize them to stick around or anything. Yeah. And then I also worked at a sandwich shop in high school. I have no idea. I can't remember how much I made. It couldn't have been much. It was just like during the summers and.
Sure.
It was certainly nothing substantial. But yeah, no real big money takeaways there. I'm sure it did help shape my perspective. And, I started saving that money, but nothing mind blowing. What about you?
No, that's funny that those are your experiences for sure. Like I think about like my first job, quote unquote, that I had. I mowed lawns growing up. Yeah. Like that was always great. And I was like, oh, this is fun. Like, and then you'd get to like where it's the middle of summer and it's really hot. Yeah. You're out there like working and mowing lawns. As you get more, it kind of develops into more of a landscaping thing. And someone's like, hey, would you mind weed eating over here too? And like, I remember being like, yeah. And it was cool to have like cash like at that. Yeah. I think I was probably 12 or 13 or something like that, and being like, wow, this is great. And I remember saving up all this money that I had earned. And when I was like 16, I took a trip to Los Angeles with a couple of friends and their dad for like one of the kids' graduation trips. And I remember I spent all of that money that I had built up for like 2 or 3 summers doing this. And then it really shaped my perspective of like, all right, I got to earn more money. That was, and I was like, and I don't want to do this forever. Like it's fun. I like it, but I got to do something else for sure. So
there's probably some lesson to be learned there too about like, it's just so much, you can spend the money so much faster than you earn it. Right. I mean,
incredible.
Again, I think I talked before on this podcast, but about that story when Shaq got his first like $1 million contract and, he blew it all in like 5 hours and, he worked his entire life to get to the NBA and worked hard and got a good contract, especially at that time, $1 million. And he was able to spend it all in literally a number of hours, less than a day.
Yeah.
So there's probably something about, again, managing your spending, because you can always spend it faster than you can make it.
Oh my gosh, yeah, it's like those. I think we did. I don't know if it was on the podcast or after the podcast when you finished recording. I think it was on. You showed me like that website where you can you have X amount of money, try to spend it,
right,
kind of thing. And I'm just like, and I was like, oh my gosh, like I could buy 2 NBA franchises, all these different things. And I, in my mind, recently within the last couple of months, the the Mega Millions lottery was like at 1.15 million or billion or something like that. And always, whenever that comes up, there's always stories about people who blow it so quickly or whatever.
Oh yeah.
And I'm like, well, I'd like to give it a shot. I'd like to have that opportunity.
Yeah, it'd be fun.
Yeah, it'd be fun. I mean, I feel like I could do relatively good things with this, but I'd spend some money. But yeah, always fun to kind of see those different perspectives. But awesome. Well, thanks, Ryan. Appreciate it as always, man. Appreciate all the listeners checking us out here. Follow us, find us, download us, rate us well on any of the platforms you might be using. And appreciate you guys. And Ryan, anything to wrap us up here?
As always, stay the course.
Thank you for joining us for the Fiscal Physical Podcast. Until next time, happy listening. And as always, stay the course. If you have a question or topic suggestions, please email us at podcast@alchemywealth.com. If you enjoyed today's discussion, subscribe to the podcast to ensure you never miss an episode. And consider leaving us a rating and review on your favorite platform. This helps other listeners like you find the show. For more resources, you can visit Alchemy Wealth Management's website at www.alchemywealth.com or find your Fiscal Physical, the book, on Amazon. We'd be remiss if we didn't mention that personal finance is just that, personal. Please don't take anything we say as advice. The preceding content is for informational and entertainment purposes only. It's not an offer or a solicitation, nor should it be construed or relied upon for tax, legal, or investment advice. It doesn't consider your personal financial situation or objectives and may not be suitable for you.